So in this video, we're going to talk about what do you do when the actual growth rate exceeds sustainable growth rate. In other words, what do you do if you don't have enough profits to pay for the expansion and assets that are needed? If it's temporary, we might just borrow some money and just wait for it to slow down, right? If not, though, we might need to take some steps, some actions. So we're going to talk about what things you could do. Well, the first thing you could do is to sell new equity, right? You could get you cash, increases your borrowing capacity. Not the easiest thing to do in most countries, though. Let's think about just in U.S. These are U.S. non-financial corporations and how they finance business. If you look here internally, about 68% of all of the money that's financed is financed through profits and depreciation, internally generated profits, capital. Externally, 47% comes from increasing debt, and you notice equity is decreasing. So companies in general don't want to, and in reality, it appears that they don't want to sell new stock. They are actually buying stock rather than selling stock. So what can we do? Option 2, increase leverage. We're going to get more money because we're going to borrow more. Of course, this raises the risk of bankruptcy. Option 3, reduce the payout ratio. This is going to save cash, right? Keeps cash in the checking account. It's going to increase by reducing the payout ratio, you increase retention. Of course, what do current shareholders think about this, right? Current shareholders might be disappointed, right? If they're upset enough, they're going to end up selling their stock. If enough of them are selling their stock, it could cause the value of the stock to drop. But what if the company is already not paying dividends now? I mean, lots of companies don't pay dividends. I mean, it's not uncommon. I don't want to say a lot of companies, but it's certainly not uncommon to find a company that pays very little, if any, dividends. Option 4. They refer to this as being profitable pruning, right? Let's find something within the company and we can spin off that business. Maybe it's not a profitable line of business. Or if we sell it, obviously we get cash, right? So if you get rid of undiversifying, unrelated product lines with no synergy, right? So this basically what? These are parts of our business that are not related, right? They don't really provide us with any benefits other than the cash flows that they bring. So I guess the question is, who benefits from corporate diversification? Is it the shareholders or the managers? Well, without getting too deep into the research, I can just tell you that in general, research has shown that it is more cost effective for shareholders to diversify than corporations. What I mean by this is, as a shareholder, if you want to diversify your investment portfolio, you may need to either increase your investment or just move some money. And that cost is relatively inexpensive, right? I mean, so you buy, you buy 1,000 shares of XYZ company. It costs you, $10,000, $20,000. But the corporation, in order for them to diversify to that kind of company, they have to spend maybe billions of dollars to buy that company. So again, undiversifying, spinning off things that aren't helping us necessarily, right? Obviously generates cash. What about outsourcing? If we can outsource some of the production that will help us increase asset turnover, right? So now we've got assets that we used to use that we are going to outsource to somebody else. We don't need those assets. So we'll sell those assets and actually get some cash. In addition to that, we're going to be more efficient moving forward. So that should increase our retention later on. What if we just raise prices? We want to raise profitability. This increases return on equity, of course. But if the percentage increase in demand, right, if it doesn't fall by more than the increase in price, then we're going the wrong direction, right? So if you increase prices and demand falls too much because of the increase in prices, then you haven't gained return on equity. You haven't increased the profit margin of the company. Option 7 is we can look at and think about mergers, right? Find a cash cow, right? What is this referred to, right? We want to find another company, another company in general, could be like our company or unlike our company, that has lots of money, and they would like to be merged. They would like to join with us because they have money, they see a need. So if we merge with that company, now we have a cash resource from that merger. So there's 7 ideas of how the company can go about getting cash and adjusting operations so that we can bring the sustainable growth rate and the growth rate of sales into balance. Look forward to seeing you in the next video.